Welcome to the deep dive. Today we're going to be exploring how expectations about inflation can actually impact the prices of stocks and bonds you might have in your portfolio.
Yeah, it's a really relevant topic right now with inflation being, top of mind for so many people.
Uh,
We're going to be diving into some research that suggests there's actually good inflation and bad inflation, and that the market reacts very differently to each.
Interesting. So the research we're looking at today is from a paper titled Good Inflation, Bad Inflation: Implications for Risky Asset Prices. What's really unique about this paper is that it uses data all the way back to 2004 to analyze how the expectation of inflation affects things like stocks and bonds.
Right, and for this, they focus specifically on the U.S. economy, and they use something called inflation swaps to track these expectations.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
Okay, so inflation swaps.
Yeah, so basically these are agreements where two parties kind of bet on the future direction of inflation. You could almost think of it like taking the temperature of the market's feelings about inflation.
So it's not just looking back at historical inflation data, but more like what investors are predicting will happen.
Exactly. It gives us a glimpse into the future. And through their analysis, they found a really important distinction between good and bad inflation. This is really at the core of their research.
Okay, so let's break that down a bit. What exactly do they mean by good versus bad inflation?
Sure. So think of it this way. Good inflation is when prices are rising, but it's happening alongside strong economic growth. It's a sign that the economy is healthy. People are earning more, they're spending more, businesses are thriving.
So like a rising tide lifts all boats kind of thing.
Exactly. Now, on the other hand, bad inflation is when prices go up, but the economy isn't really growing or might even be shrinking. That's what people usually think of when they hear stagflation, like what we saw back in the 70s, high inflation with high unemployment.
Got it. So it really depends on what's driving those rising prices, whether it's actual growth in demand or something else that's hurting the economy.
Yes. And what the researchers found is that the market reacts in very different ways depending on which type of inflation is expected. So, for instance, when investors expect good inflation, something really interesting happens with credit default swaps, or CDS.
CDS, can you remind us what those are again?
Oh, yeah, sure. So imagine you're lending money to a company. There's always a risk that that company might default on their debt, right? A CDS is basically like an insurance policy against that risk. If the company defaults, the CDS pays out.
Ah, okay. So it's a way to hedge your bets.
Exactly. Now, what the research found is that when investors are expecting this good inflation, CDS spreads, which is basically how risky the market perceives that company's debt to be, tend to decrease.
So if they're expecting healthy economic growth along with inflation, they're less worried about companies defaulting on their loans.
That's right. It's reflected in those CDS spreads.
Interesting. What about the impact on equity returns, though? What happens to those?
Well, that's where things get even more interesting. They actually found that during times of expected good inflation, equity returns, meaning the returns you're getting on your stock investments, tend to increase.
So basically a win-win for investors. Companies seem less risky and stock prices are going up.
Yeah, it seems that way. But then the question is, what happens during those periods of bad inflation?
I'm guessing the opposite happens, like CDS spreads increase and equity returns take a hit.
You got it. The research suggests that when investors anticipate bad, inflation companies are perceived as riskier, so those CDS spreads widen and stock prices could decline.
So really, it's all about investor sentiment. How the market perceives future inflation can be just as important as inflation itself.
Absolutely. And the researchers actually quantified this impact. They found that a 1 standard deviation increase in expected inflation could lead to a pretty significant decrease in CDS spreads and a substantial boost in equity returns, all within a single day.
Wow, so even small changes in those expectations can have a big impact on the market. And the direction of that impact depends on whether they see it as good or bad.
Exactly. And it doesn't stop there. The research actually goes on to look at something called the stock-bond correlation, which can give us even more clues about how the market's feeling about inflation. Think about it this way. We usually think of stocks as representing growth. You know, people buy stocks hoping that companies will grow and their share prices will increase.
Right, and bonds, especially government bonds, are seen as more of a safe haven. When investors start to worry about the economy, they often move their money into bonds for that stability.
Exactly. Now, this correlation between stock and bond returns, it tells us how these two asset classes are moving in relation to each other. So when the correlation is strongly positive, meaning they're both moving in the same direction, up or down, it can be a sign that investors are a little bit spooked about the future.
So if both stocks and bonds are dropping together, it's like everyone's running for the exits because they're worried about what's coming next.
Yeah, that's a good way to put it. On the other hand, when that correlation is negative, meaning stocks are going up while bonds are going down, it suggests a more optimistic outlook, or maybe the market's expecting some of that good inflation we were talking about.
So just by keeping an eye on this correlation, we can get a sense of whether the market is feeling good or bad about the relationship between inflation and growth. But I'm curious, how did the researchers actually measure the impact of these expectations? What did their findings show?
Well, they dove into something called risk premia. Remember when we talked about CDS spreads reflecting how risky corporate debt is perceived to be? Well, risk premia are a big part of that.
Okay, remind me what a risk premium exactly.
Think of it this way. You're lending money to a company and you want a certain return on that loan, right? That return has two components, the expected loss and the risk premium. Expected loss is basically what you might lose if the company actually defaults on the loan.
Makes sense. But what about the risk premium?
That's the extra return that investors demand on top of that expected loss to compensate for the uncertainty of lending the money. It's like an uncertainty tax you're paying for the risk that things might not go as planned.
So even if I think a company is unlikely to default, I'd still want a higher return just because there's always a chance that something could go wrong.
Exactly. And the researchers found that when it comes to the impact of expected inflation on those CDS spreads, a large portion of it actually comes from changes in those risk premia rather than changes in the expected losses.
So it really highlights how much investor sentiment plays a role. When there's uncertainty about what inflation will do in the future, investors want to be compensated more for taking on that risk.
Right. And the interesting thing is this effect can vary depending on whether the market sees the inflation as good or bad. If they're expecting good inflation, they tend to be more confident about the future. So risk premia are lower.
Which would explain why CDS spreads go down in those situations, even if the actual risk of the company defaulting hasn't changed.
That's it. It's all about perception. But when investors see bad inflation on the horizon, those risk premia can shoot up, driving CDS spreads higher even if the actual default risk is the same.
So understanding how these inflation expectations can shift to those risk premia is super important for investors, especially right now when inflation is such a big concern.
Absolutely. And the researchers actually went even deeper looking at how these expectations can shift on a much more granular level. They looked at intraday changes in inflation swaps.
Intraday, like minute-by-minute changes.
Exactly. They wanted to see how those tiny, almost imperceptible shifts in expectations might be rippling through the market in real time. They specifically focused on the period around major macroeconomic announcements, like when new inflation data comes out or the Fed makes a statement.
Yeah, those announcements definitely have the power to move markets. What did they find?
They found that even those small intraday changes in inflation swap prices were having a measurable impact on both CDS spreads and equity returns.
So even the smallest blips in expectations can have a real effect. But I imagine it still depends on whether investors are feeling optimistic or pessimistic about the type of inflation that's coming.
Right. They observed that same time-varying effect we talked about with the daily data.
Wow. It really underscores how important it is to pay attention to even the smallest shifts in sentiment. But how did they isolate the actual impact of those news events? I mean, intraday trading is incredibly volatile. Prices are bouncing around constantly.
They used some pretty sophisticated techniques to isolate the specific impact of that macroeconomic news on those intraday inflation swap movements. They essentially filtered out all the other market noise to see the pure signal coming from the news itself.
So they could really zoom in on how the market was truly reacting to that new information about inflation.
Exactly. And what's even more fascinating is that within all that noise, they uncovered a hidden layer of information, what they call the latent component of inflation swap movements.
Right. Latent components. That sounds intriguing. What exactly is that?
Think of it as everything that's moving inflation swap prices beyond just the headline news itself. It's like the market's unspoken interpretation of what that news actually means. All those subtle nuances and individual assessments that investors are making, even if it's not explicitly stated in the announcement.
So it's almost like the market is reading between the lines, adding its own commentary and interpretation to the raw data.
That's a great way to put it. And they actually found that this latent component can be just as influential as the headline news itself when it comes to driving market reactions.
So even if two announcements have the same headline figures, the market's response might be different based on how it's interpreting and analyzing that news.
Exactly. It really highlights how important it is to go beyond just reacting to the headline and really pay attention to the underlying sentiment and how the market is actually processing that new information.
This is all really fascinating stuff. Seems like there's always more to the story than meets the eye.
Absolutely. And we haven't even talked about the elephant in the room, the Federal Reserve.
Oh, right. What role does the Federal Reserve play in all this?
Well, the Fed's actions can definitely have a big influence on how investors are perceiving inflation. Remember, their main goal is to keep inflation under control, and they use interest rates as their main tool for doing that.
Right. So if the Fed is raising interest rates pretty aggressively, it's a sign that they're worried about inflation getting out of hand. Would that make investors more likely to see it as bad inflation then?
Yeah, it definitely can. If investors see that the Fed is taking strong action to try and curb inflation, they might interpret that as a signal that inflation is a serious threat and that they need to be cautious.
So it's almost like the Fed's actions are kind of reinforcing those negative expectations.
Yeah, in a way. But the opposite can also be true, too. If the Fed is keeping interest rates low, it might signal that they're not overly concerned about inflation, which could then lead investors to perceive it as more of that good inflation.
So the Fed isn't just managing the economy, they're also managing expectations. Those expectations can have a real tangible impact on how inflation affects our investments.
Exactly. That's why it's so important for investors to not just focus on the inflation numbers themselves, but to also consider the bigger picture, what's happening in the economy overall and what the Fed is doing and saying.
This has been a really eye-opening deep dive. We've learned that there's good inflation and bad inflation, that expectations play a huge role, and that even tiny shifts in sentiment can ripple through the market.
Yeah, and we've also kind of uncovered this hidden language of the market, that latent component that reveals those unspoken interpretations and sentiments that can really drive those asset prices.
So what's the big takeaway here? What should our listeners been thinking about when they hear reports about rising inflation?
I think the biggest thing is don't just react to that headline inflation number. Dig a little deeper. Ask yourself, is this good inflation or bad inflation? And how might it affect my own portfolio?
And how can people try to figure out whether the market is viewing it as good or bad?
Well, pay attention to things like those inflation swaps we talked about. Keep an eye on that stock-bond correlation and consider what the Fed is doing and saying. All those things can give you clues.
Right, and don't forget about those market whispers, that latent component that can reveal those subtle shifts in sentiment. The more information we have, the better decisions we can make.
Absolutely. This research gives us a really useful framework for understanding this complex relationship between inflation expectations and how they affect the prices of risky assets.
This has been a fantastic deep dive. So much valuable information to think about.
Definitely a topic worth revisiting as things continue to unfold with inflation.
It's definitely something worth exploring further. Until next time, happy diving.